It's time for the markets. Asian markets started on a positive note following the positive close in U.S. markets last Friday, but later saw a mixed bag performance influenced by various factors. Japanese stocks rose on the back of gains in the marine, transport, power and gas and water sectors. The Nikkei share average closed up 1.78%, hitting a one-month high. The Hang Seng Index in Hong Kong closed in the red, down 1.18%. This was likely influenced by unflattering manufacturing production numbers out of China. On mainland China, the Shanghai Composite Index was also down, closing 0.77% in the red. Over in the United States, a robust, broad-based rally sent Wall Street to a sharply higher close on Friday. Encouraging economic data and a rosier earnings outlook boosted investor risk appetite ahead of this week's much-anticipated two-day policy meeting of the Federal Reserve. Financial markets have now priced in an 84% likelihood of a fifth consecutive 75 basis point interest rate hike by the Fed. The S&P 500 gained 2.46%. The Nasdaq Composite gained 2.87%, while the Dow Jones Industrial Average rose by 2.59%. The JSE was mainly firmer at midday. The all-share index has added 0.3% to 66,625. The industrial 25 index is 1.3% higher. Financials are 0.6% down. Markets in Europe are mixed. Britain's FTSE 100 is up 0.2%. Germany's DAX is up 0.1%, while the Paris CAC in France has shed 0.1%. Looking at the commodities, gold is trading at around $1,637 and platinum at $926 per ounce, while the price of Brent crude oil is trading at around $94.50 a barrel. The rand is trading at 18 Rand 33 to the dollar, 21.14 to the pound and 18.20 against the euro. Well, to take us through the markets, I'm joined by Gary Boyson. He's a portfolio manager at Rand Swiss. Thanks very much for joining us, Gary. So this week is the Fed's decision on interest rates. Are we likely to see further jitters on global equities?
I think jitters are the norm for markets at the moment. So, the expectation is widely that we're going to see a 75 basis point increase. So of the Refinitiv poll, 90 economists were polled, and of that, 86 of them think we're getting 75 basis points increase. Only 4 of them think that we'll get a 0.5% increase. So it's quite clear what the expectations are. Now, whether or not they're going to be jitters ahead of that, it's difficult to say. These days, markets are very, very volatile, and I suppose, anything's possible. But let's hope we get the 75 basis point increase, and the market gets what it's expecting, and hopefully we can see the start of this little recovery that seems to be filtering through continue.
Yeah, isn't there a danger, that the Fed may actually end up overdoing it simply because you don't really get a sense of the impact of an interest rate increase until several months later? And given that they've already instituted 4 consecutive 75 basis hikes, isn't that likely to see the U.S. economy actually go into a recession, a prolonged one?
Well, I suppose we can debate whether or not the U.S. economy is already in a recession. They had the 2 quarters of negative growth, but of course the labor market in the U.S. is still very, very strong. With unemployment at 3.5%, you're 100% right. We haven't yet seen the effects of the interest rate increases filtering into the underlying market. And I think that's what everyone has their eye on at the moment. When will we see something happening in the underlying economy? When will we see that unemployment rate start to lift a little bit? And when will we see inflation coming down? So, unfortunately, even if we get a 75 basis point increase on Wednesday, that only takes the federal funds rate to 4%. And unfortunately, the inflation figure in the US is still 8.2%. So, real interest rates are still deeply negative in the US. Now, as I said, everyone's hope is that we're going to see the Fed pivot a little bit earlier. I think the market is largely trying to price that in, first quarter, beginning of second quarter next year. Whether we're going to get it or not, I mean, already there are, I suppose, guesstimates that we might see only a 50 basis point increase in the December meeting. But until we see some bad numbers, until we see the economy starting to respond, I find it very difficult to believe that the Fed is going to blink, as so many people, especially in the equity markets, are hoping.
Yeah. A few months ago, we all breathed a sigh of relief when Ukraine was able to start exporting its grains again. Now we understand that Russia has pulled out of that deal that was facilitated by Turkey in the UN to allow the Ukraine to send, grains across the world. What sort of impact has this had on, is it the Chicago Board of Exchange where grains are traded?
Yeah, absolutely. So in Chicago, we saw the wheat price up around 7.7% on the news. It did pair some of those gains as trading moved across to Singapore in the morning. But there's no question that this is an absolutely crucial deal to ensure global soft commodity supply, specifically wheat. Looking at it, this is in response to obviously the drone attack, in the Black Sea and Russia pulling out. But, you almost feel that it is a little bit of a pretext. Russia has already said previously that they're unhappy that, the Ukraine shipments are getting through, but Russian shipments are still being blocked. And at this stage, there's no question Russia is starting to target Ukraine infrastructure. And it is clearly that there has been an escalation of the conflict. The US has already come out and said that Russia is using food as a weapon. But the real impact, I suppose, on markets is going to be, the embedding of inflation. So if you get a supply shock like we saw earlier in this year, where there's essentially food prices go up because supply is constrained, but then supply comes back online, it doesn't adjust inflation expectations. People don't go and ask for a higher wage increase immediately. They kind of see through the issue. The problem is the longer that a supply shock is in the system. So the longer we have high oil prices and high food prices, the more likely it is that we'll see increased wage demands. And when wages go up, that's when inflation really does become embedded, because commodity prices like oil and food can fall. Grain prices can fall if supply comes back on stream. And unfortunately, wage prices are far, far more sticky. And then we will have, inflation will become a much more dire problem. And the hope that we might see a Fed pivot, end of this year, early next year, goes out the window.
Yeah.
And inflation will be a real problem.
Speaking of inflation, especially wage inflation, how worried are you about the whole public sector wage talk situation? Because government made a provision of 3% for this fiscal year, but it looks as though public sector unions aren't having it and they're demanding 10%. They say that for many a year now, they haven't asked for increases. And of course, government reneged in 2018 on rolling out the third year of the agreement that they had with government. Do you think that the fiscal framework that was presented to us last week may change dramatically?
Well, I hope not. If you look at where South Africa is at the moment, our debt to GDP ratio is improving. Part of that is because of the high inflation number, and of course almost the windfall that we had from much higher commodity prices, being obviously a commodity exporting nation. Now, with that, unfortunately, that commodity prices are very, very cyclical. Things can change very, very quickly. And it was good to see in the mini budget that there was a commitment to not increasing permanent spending plans in the face of what looks like a temporary collection. So in that way, I think it was certainly a good mini budget, and our reading is that it's neutral to slightly positive from a credit ratings point of view. But definitely, it's South Africa is in a very, very tricky position at the moment, and obviously we're seeing things like the extension of the temporary COVID grant, and we have to balance growth and infrastructure spending against a more constrained budget. So against the idea of putting out a very austere budget. So I think we at the moment we're doing as best we can, but yeah, there's plenty of risks to South Africa. I think one of the largest ones being that commodity prices come down dramatically in the face of rising interest rates internationally. If we see a real slowdown in global growth and thus a fall in commodity prices, our fiscus will be under pressure. There's no question about it. And it's, I suppose, about trying to strike that very, very delicate balance.
Yeah, like you say, it's tricky. Thank you very much, Gary, for your time. As always, Gary Boyson, he's a portfolio manager at Rand Swiss. We're going to take a quick break. We'll have more business news for you thereafter.